The largest restaurant chains in America are struggling to overcome waning demand as the economy continues to slow down. Even giants like Domino's Pizza, which operates almost 19,000 stores worldwide, are reporting a series of challenges and financial losses in 2023. The chain is now closing thousands of underperforming locations after recent price hike controversies depressed domestic and international sales and sent its shares plummeting to the lowest level in over a decade. The latest data shows that the pizza company is in far more trouble than we all thought, and experts say that if it fails to fix its problems before the current downturn gets worse, the American pie chain may rapidly become overwhelmed by its debt and fall victim to the great retail collapse. That's what we're going to expose today. But before moving on, we kindly ask you to support our work with a thumbs up, and don't forget to subscribe to our channel. A decade of strong growth allowed Domino's Pizza to expand its store count from 10,255 locations at the end of 2012 to 18,848 at the end of 2022. Since 2017, the company led U.S. pizza sales, and the pandemic boom pushed its stock to hit an all-time high of nearly $565 in 2021. But things dramatically changed in the fourth quarter of 2022, when the pizza chain's disappointing earnings report revealed that sales were dropping at a much faster rate than investors were expecting. In February, conditions for the company have gone from bad to worse. In a single day, share prices plunged by a whopping 16%, marking the largest price decline since 2010. From that point on, share prices have continued to trend down, settling around $310 per share, or about 39% lower than during the same period a year ago. Now, thousands of stores have started to close, with Domino's making the tough decision to shutter its entire operations in some areas due to profitability concerns. It all started when, just like many other U.S. restaurants, the pizza chain started to adjust to the inflationary environment and raise its delivery and menu prices to offset higher labor and commodity costs. In October 2022, executives reported a 7% price hike that prompted many customers to cook at home instead of getting their meals delivered. Overall, the chain's prices remain 12% higher than pre-pandemic levels, according to Eat This, Not That. Industry experts argue that its pricing strategy was not efficient, given that the company failed to consider changing consumer spending habits and how competitors' price increases compared to its own. A new report reveals that Americans became very dissatisfied with the new prices, which led sales to sink all across the country. The issue can be partially attributed to the fact that Domino's targeted some of its most popular deals with higher prices, such as the Mix and Match deal, which went from $5.99 to $6.99 in December. Domino's also made some key changes to its popular carry-out deal, which currently offers customers a pizza, dip and bread combo, or wings for $7.99. While the company didn't raise the price of the deal itself, it did reduce the number of wings it contains from 10 to 8. On top of that, it now only allows customers to order one topping on a pizza as part of the carry-out deal, when it previously allowed them to choose 3 toppings. The chain further limited this deal by turning it into a digital-only offering, excluding those ordering in person or over the phone. Customers weren't happy about these changes. Unfortunately, it's now cheaper for me to buy my favorite frozen pizza than a Domino's pan pizza, so that's what I'm doing going forward, one user wrote in a Reddit thread. I only used to get food from there occasionally because of deals like this, another Reddit user wrote in a separate thread about the changes to the $7.99 carry-out deal. Nobody's going to pay normal pizza prices for Domino's. Delivery problems are also weighing on Domino's bottom line. the Michigan-based pizza brand is still experiencing a serious shortage of delivery drivers. With workers seeking out higher wages and better working conditions en masse, many just aren't interested in delivering pizzas anymore. Despite this clear shift in the U.S. labor market, Domino's has been hesitant to partner with third-party delivery options like Grubhub or DoorDash, thus losing customers to other rivals. U.S. CEO Russell Weiner and CFO Sandeep Reddy revealed that Domino's is facing significant pressure on its domestic delivery business. The executives expect those issues to intensify in the months ahead. With inflation still forcing Americans to curb spending, more and more customers might think that delivery fees, which are set by local stores and franchises, just aren't worth it. As we saw in the last recession, delivery moves with the economy, especially for customers with lower disposable income, who represent a significant portion of our business, Weiner said, adding, "We expect the economy to be a headwind for our delivery business in 2023. Every day, delivery customers will be deciding where to spend their hard-earned dollars, so we need to maintain value and to continue to improve our service." Weiner noted that service times are not better than they were in 2019, and that's a place we need to go. North Coast research analyst Jim Sanderson says that Domino's weakness is raising a red flag for other major restaurant and fast food chains. The challenges in its delivery business, coupled with macroeconomic pressures, prompted Domino's to trim its outlook for global retail sales growth to between 4% and 8% over 2 to 3 years. It had previously expected growth of 6% to 10%. To make things worse, Business Insider reports that in recent years, the brand lost about $155 million on delivery projects that were a complete fiasco. Last year, the company rolled out a fleet of 800 Chevy Bolt electric vehicles to deliver pizzas in an attempt to attract employees who didn't already have cars of their own. The previous year, Domino's teamed with the robotics company Nuro to experiment with autonomous pizza delivery that delivered orders from a small self-driving robot car, but these efforts didn't pay off, and sales continued to stagnate while talent shortages persisted. In its latest earnings report, data showed that Domino's same-store delivery sales declined by 6.6%. That figure raised major profitability concerns and has sparked a massive sell-off that has wiped $830 million from its market cap value so far this year. The crash has put the company in an even more complicated position given that it buys its own stock through repurchase programs. But Domino's stock buybacks have exceeded the company's total free cash flow multiple times over the past 10 years. Domino's also pays a dividend, which uses nearly 30% of its cash flow. In other words, it's now spending more money than it's making. Motley Fool's Justin Pope shared that the pizza brand is taking on increasingly higher debt over time, now up to $5 billion against just $165 million in cash. Its debt is more than 5 times the company's EBITDA, the earnings before interest, taxes, depreciation, and amortization. This is unsustainable, and with interest rates rising amid a potential recession, Domino's will likely get a lot more conservative moving forward. It's one thing when 0% rates make debt cheap, but borrowing is harder when rates go up, Pope wrote. At the same time, in overseas markets, things are looking even uglier right now. Last month, Domino's Australia lost $1.5 billion of its market value after international chief executive Don Mage warned that home delivery orders were slowing, and some customers weren't buying pizzas as regularly because of the country's ongoing cost of living crisis. In the first quarter, the brand's shares plunged 23.8% to close at $54.37 as Aussie investors headed for the exit after a dive in profits in the previous quarter, as well as a 24% cut in the dividend payout and the expectation that the next 6 months could be even tougher. Net profit fell 28.3% to $63.9 million, while revenue dropped 4.3% to $1.154 billion. In some countries, the company has decided to close a large number of stores that have been underperforming for years. In the Aussie market, Domino's will reduce the size of its current corporate store network of about 913 stores by 15 to 20% through closing underperforming stores and accelerating the refranchising of corporate stores in turnaround, a spokesperson said. Meanwhile, in Denmark, the brand has decided to shutter all of its stores, which Mage said had generated too many losses. "We bought a damaged business in the Denmark market and thought we'd be able to grow it a lot faster than we've been able to," Mage said. "For the size of the losses, we just said it's not worth it." Earlier this year, the executive noted that sales in Europe had slipped by 4% and said its plans to fight inflation had not been optimal, with increased product prices and delivery and surcharge fees impacting how often customers ordered. Opal Capital Management Chief Investment Officer Omkar Joshi said that the pricing missteps did more harm than good to the business over the past year. Domino's has been less resilient than many would have expected, Joshi said. They're in a tough position and are entering a more challenging environment than last year. Moreover, it looks like Domino's failed to sell pizzas to Italians. In April, ePizza, Domino's Italian franchise operator, filed for bankruptcy and suspended operations at all of its locations in the country. In its bankruptcy filing, ePizza SPA explained that pandemic lockdowns had increased the popularity of other food delivery services, which made it financially impossible for its Domino's locations to continue to do business. When the brand entered the Italian market 7 years ago, its home delivery was a way for it to differentiate itself from local pizzerias. In the months since the pandemic, the increased popularity of and reliance on companies like Just Eat and Deliveroo have made Domino's delivery seem less attractive and less necessary. We attribute the issue to the significantly increased level of competition in the food delivery market, with both organized chains and mom-and-pop restaurants delivering food to service and restaurants reopening post-pandemic and consumers out and about with revenge spending, ePizza highlighted. And locals didn't exactly care about Domino's closures. There was no point in opening it. We were talking about it just this morning, one Bologna resident told Reuters. It didn't make sense. Maybe an American pizza chain would have made sense for tourists, but for an Italian, it doesn't make sense. It's like me going to England and making fish and chips. It doesn't make sense. But even in America, the chain is losing ground and market share. Over the past 6 months, Domino's significantly underperformed rivals including Pizza Hut and Papa John's, which actually benefited from new menu news and third-party delivery marketing and driver service. It has an unwillingness to adapt to the current market, while rivals get stronger and snap more market share, and that may throw the company over the edge. Considering how high its debt currently is and the depth of its profitability concerns, Domino's must come up with better strategies to rebalance its finances soon, because not even the largest pizza chain in the world is infallible and immune to the impact of recessions and downturns. This could be the beginning of the end for the company, as the U.S. retail apocalypse continues to claim more and more struggling businesses that fail to differentiate themselves in this wildly competitive market. Thank you for watching.